Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, January 29, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. We have a lot of stuff going on this week. There is a laundry list of items this week that should bring volatility right back into this market. We already saw it begin today. We had a nice healthy take back, not in total, but a nice take back in part, almost all of it, of Friday's move. That was a nice big move. It was potentially a finishing move, at least for this leg of the rally. I'm not suggesting the entire rally has to be over right now, but what I am going to suggest, it coincides with a laundry list of things that we're going to discuss in a minute. But what I am suggesting is, since we obviously are due for a correction in this market, doesn't have to be a ton of correction. It doesn't have to be a 10 or 20% correction, but we certainly are due for a correction. It doesn't have to damage the long-standing uptrend of this market right now. This is the perfect recipe. This week is the perfect recipe for a correction to begin in this market that should take the market down at least a few percentage points and bring the market back down to earth and take some air out of this bubble. So what do we have on the docket this week? We have a ton of earnings hitting this week from large companies that are resident in hedge funds and mutual funds. All the names we know, a lot of them are priced to perfection, and it is the perfect recipe for a couple of these earnings announcements to be taken as not necessarily negative, but for some selling to emerge, and we can term it as profit taking. We'll see what happens along the way, but when you have companies like Apple and Google and Amazon and Netflix and all these companies that are up a ton reporting earnings, not all of them are reporting this week, but a lot of them are reporting this week, then it really is the perfect recipe for some profit taking to hit. And when those companies have some money sucked out of them, it's going to drag, or if it does, it will drag the rest of the market down with it. Netflix reported last week, but there's a ton of earnings hitting this week. This is probably the largest earnings week we're going to see this season. What else do we have on the docket this week? We also have the State of the Union address. President Trump will be giving his State of the Union. That, not all the time, but a lot of times can mark a turning point for the market. Now, we may have heard a turning point today. That's certainly possible. But the State of the Union is tomorrow night, Tuesday evening, and we'll see how that impacts the market. It depends on how the market participants wants to take not only what he says, but the reaction to what he says. Remember, half the country's for him, half the country's against him. We'll see how that all shakes out. Another important item we have on the board this week is a Federal Reserve meeting that takes place January 30th to January 31st. So that's also tomorrow into Wednesday. So we'll see how that impacts the market. The culmination of a Federal Reserve meeting or FOMC meeting can certainly have an impact on a lot of markets, not only the stock market, but the bond market, the currency market, across the board. And another thing we have, and this is mainly for folks that they don't have to believe in this stuff, but certainly these type of events do have, not all the time, but a lot of the time, have an impact on the market. We are having a lunar eclipse on January 31st at 8:27 a.m. This happens to be a unique event. You can look it up for yourself. You can read all about it. It happens to be what we call a blue moon. It will also be known as a supermoon. And it happens to be, this culmination of the event this week happens to be a very rare event. That can also happen to have an impact on the markets. So when you put that in against the State of the Union, in against the Federal Reserve, in against the earnings announcements coming, we should see some volatility come back into this market and certainly have an impact one way or the other. Now, looking back at the SPY, I have three specific numbers on the chart. The first number on the downside I have, and this is only if we continue down, right? If we could just continue up and all that stuff has a positive impact on the market and we just continue to make new highs, then these downside numbers will be off the board. They're not going to obviously come into play. But if we should see the market come down further, the first area of concern will be 283.96. If we end up seeing hourly closes first, and then of course a daily close below that number, that's going to bring into play what I believe is the next important downside number of 281.85. So that's a nice little sell from there. That represents about 30 S&P handles from where we finished out Monday's session. We haven't seen any kind of a decline like that in quite some time. And the number below that, if that level should not hold or does not hold, then it's going to be about another 20 S&P points down or 2 SPY points down at $280 even, probably a pierce through that $279.50 to $280. Just to give you a better sense from a shorter time frame on the charts of what I'm looking at, I'll bring it down to an hourly chart. And here what we have is that 283.96. That was where the market broke up to the upside the other day. We will come down to that level, and that level will most likely hold intraday. If that level does not hold and we begin closing hourly below that level and then close the day below that level, not in a straight line because there are support levels along the way, namely the 50-hour moving average. You have a gap fill here that comes in between. But the next real area of support that I see on the chart is about 281.85. You can see the market consolidated at that level, broke out, came back to retest that level. That's the market's way of telling us that that's an important level on the charts. So there's your consolidation inside the circle on the left, and then the arrows pointing to the retest of that level, and we talked about it when it happened, and then we took off, we consolidated and then took off to the upside. So it would not be uncommon for the market to come back down and test that general area. That comes in right around 281.85, could be off by, 20 or 30 cents, but that's the general concept of what I'm looking at in terms of numbers. If that doesn't hold, then we come down to that $280 level, and you can see the importance of that level as well. Here's a pivot here. That's the market's way or the chart's way of telling us that level's important. We consolidated along that level for a while, underneath it, and then broke out to the upside. Markets like to come back and test former breakout and former breakdown areas. This obviously qualifies for a former breakout area, so it would not be uncommon for the market to come in and test that area one more time. That also coincides with the 100-period moving average on the right side of the chart, right in this zone here. So that would be a natural area where the market would likely find at minimum of intraday support, most likely daily chart support, and that would last for a few days at minimum. So if the market should continue down farther, this is the best assessment that I can give you on the downside of where the legitimate support areas should be. Now looking over at the IWM or the Russell 2000 Index, my favorite market leading indicator on the up and the downside, we noted last week that the Russell was not breaking out along with the spiders making new highs. They were close. We made a new high one day, we had a closing high, and then we had a reversal. Now, the closing high was generally or is generally a tip-off that higher prices are coming, and it is entirely possible that the Russell Index could be just consolidating to go higher. So we have an up move. This could be just a pullback or consolidation, a bullish wedge pattern, and we could go higher from here. But if I'm right and the market comes down, the likely story is the Russell will come down also. The Russell was not following suit late last week as the NASDAQ and the SPY and the S&P 500 were headed higher. The Russell was not breaking out along with those markets. We talked about it when it happened, and therefore it was likely that the Russell was trying to tip us off that there was something coming that was most likely of the downward variety. So we'll see how that shapes up this week. You will find support in the Russell. You have a pretty good support level right here, right around 156.50, 156.60. and then another support area right around 155 even. Keep in mind, I just want to reiterate this one more time. Any downside we see, I'm not looking for a total collapse in this market. That's not what we're talking about. We're looking for a garden variety correction to take place. Maybe it lasts for a few days. Maybe it lasts for a week and a half, 2 weeks. But I'm not necessarily looking for a ton more than that just yet. We'll get more corrections this year along the way. But right here, right now, I'm just looking for a garden variety pullback. The next thing we'll take a look at tonight is the VIX. Obviously, you can see the VIX had a nice big spike higher today, up almost 25%. And we talked about the VIX each and every time it gets below 10. And I say every time the VIX gets below 10, especially in the low 9 category, it's an area where you can buy the VIX and will be rewarded as long as you give yourself enough time. Now, giving yourself enough time means if you're going to buy call options on the VIX, you have to buy them a few months out. That's giving yourself enough time. If you're going to buy the exchange-traded products, such as the VXX or even the leveraged products, again, you have to be willing to hold these for a little while, and you have to be willing to understand that the VIX could languish down in the 10 area for a while, but when it moves very, very fast, and we're seeing evidence of that today. We saw last week, and we talked about this bullish pattern that was developing. We had an up move. We had a little pullback into the top end of the moving averages. We talked about the fact that it was holding above the moving averages, and here we have the spike today. Now, the VIX is overbought on a very short-term basis, so we'll see what happens during the Fed announcement or the Fed meeting between Tuesday and Wednesday. Maybe the market stays quiet, maybe the VIX comes down a little bit, but we do have all those other events taking place, so the market can get whippy and it can have large spikes in both directions, both the upward and the downward directions, so you have to be careful. The transportation average, my second favorite leading indicator on the up and the downside. The transports came down pretty hard last week. We talked about it. We had a bearish pattern. That played out. We came into the 20-period moving average, and then Friday we had an up day, and today we basically had almost a flat day. The market was up a little bit earlier, and then it finished near the flat line down 11.5 points. But the transports were also an indicator that the market or the transports were giving us a heads up that there was something else going on underneath the hood of the markets, and likely we were going to see at least the transports catch back up to the upside, or the market catch up to the transports and the IWM on the downside. At least from today's activity, it looks like the market wants to catch up on the downside. However, you're going to see rallies, you're going to see spikes in the upward direction. When the market starts to correct even a little bit, you end up seeing large swings in both directions. It sucks people in on the long side. It has a nice big spike on the upside, and then they pull the rug out and they have another flush downward. That's the way corrections happen. They don't happen all at once, and it doesn't move in a straight line. It tends to move in a very whippy nature, when and if they do happen at all. The gold market continues to come down farther. The gold market is most likely headed back to the 1338 level. That was resistance on the upside, and you can see where we traded around that level when we got there on the upside, and then we're likely going to come back to test that level. It is what I would consider somewhere in the neighborhood of a breakout level. It's also coinciding with the 20-period moving average. We're likely to find some support at that level, but make no mistake about it, when the Fed makes their announcement on Wednesday, you're likely to see markets get very volatile around the currency markets, which will also in turn become volatile for the precious metals markets, potentially the crude oil market, and of course the stock market as well. So if we don't hold the 1338 level in the gold market, look for 1326, 1325 on the downside. If that doesn't hold, you're going to have around 1315, and then the moving averages that are converging, the 50 moving average converging with the 100 period moving average, all the way down at 1302 spot 40 today. That number will move slightly as the week goes on. Crude oil had a little bit of a down day today, down 1%. Not a big deal. Nothing wrong with this pattern, nothing wrong with this trend in the crude oil market. It's obviously in a large bullish uptrend. We can certainly come down to work off some of the overbought condition, and still maintain the uptrend. And therefore, I'm still looking for ultimately higher prices in crude oil. Doesn't have to happen all at once. Generally won't happen all at once. If it works off some of the overbought condition and comes down to the $63, maybe even $62 level, that's okay. Doesn't really do too much damage to the longer term uptrend. I think we're going to get to, and I'll show you the number on the longer term chart, the weekly chart. I think we're ending up, or will end up, at 73.78 is the number I have on the upside for crude oil. I'm not sure we're going to get there, but you can see we're very close to the 200 period moving average. If we go sideways and consolidate even slightly lower underneath the 200 period moving average for a while, then that's going to diminish the importance of the 200 period moving average. And then if we have one more run higher in crude oil, the likely stopping point, as far as I can tell, is 73.78. Maybe it spikes that a little bit. Maybe it gets up to 74, maybe even 75. But the mathematical number that I calculate is $73.78 a barrel on the upside in crude oil. And the last market we'll take a look at today is the dollar. And the dollar being up today and the dollar having been up the other day on Thursday also is putting potentially some downward pressure in precious metals and crude oil. Doesn't happen all the time, but the dollar was so oversold that any kind of rally in the dollar and sell-off in crude oil and the precious metals, namely gold, will certainly have an impact as far as the media is concerned. So it tends to become a self-fulfilling prophecy when those things happen. They're not correlated all the time, but they can be correlated some of the time. What we have here in the dollar on Thursday is what I would consider a bottoming tail. That's this candle right here on Thursday the 25th. Now, on Friday, we had pretty good retrace of that level. So we retraced downward about half of the tail candle from the day before, and today we're starting to get some follow through to the upside. So this is, at least in my book, a textbook bottoming tail, retrace, and now the market's trying to follow through to the upside. I think we're going to have the telltale sign occur at the culmination of the Federal Reserve meeting and all the other items that we talked about that are occurring this week. I think most of them are going to have an impact on the dollar. So this week is going to be a very important week for the dollar and a very important week for markets across the board. And with that, it's everything I wanted to and intended to discuss tonight. So I'm going to give it a wrap there. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.